Hi everyone, welcome to another live session. And today we are on the day 43 of 365 days challenge. I'm Archana Bingade, your truly friendly financial guide. And today we are diving deep into the world of tax benefits under Section 54 and 54F of the Income Tax Act. Be ready for some essential insights into the capital gain on property transactions. So grab a seat, get cozy, and let's start on this tax saving adventure together. Understanding Section 54, capital gain on property. Let's start things off with the Section 54, the superhero of capital gain on property. If you have recently sold a house or any other property, you might have earned a profit, which is known as capital gain. Usually, this capital gain would be taxable, but, however, under Section 54, you can save on taxes if you reinvest the sales proceed into another residential property. Isn't it wonderful? So now the tax benefits if you meet conditions. So what are the tax benefits if you meet the condition invest the entire sale amount into another residential property within specified time frame? Is that you need not pay any taxes on these gains. It's like a tax holiday for your property transactions. But hold on, there is more news. If you can't find the perfect property immediately, you have the option of depositing the capital gain amount in a capital gain account scheme before filing your returns, before the due date of the filing your income tax returns specifically. So this way you get additional time to look for your dream home without worrying about the tax implications. So what are the conditions and eligibility? Let's see that. There are some important details, the conditions and the eligibility criteria about this. To avail the tax benefits under Section 54, you might be an individual or a HUF, that is Hindu undivided family. Additionally, the property you are selling should be a residential one, and the new property you are buying or constructing must be also residential. You have either 1 year before the sale or 2 years after the sale of the property to find the perfect new home or to start the constructions. And remember, the new property must be situated in India. This exemption is available only on purchase of residential property in India, and any property purchased outside India, that is overseas, is not eligible for tax exemption. Transactions, so transition to Section 54. What if you're not looking to reinvest into another residential property? In that case, we can look at this section. This section comes into the play when you want to invest your capital gain in a different way. So, what do you do here basically? This is nothing but a non residential property investment. So, section 54F is which one you will use basically to invest in a non residential property. So the conditions are very much similar. But here, instead of restricting yourself to another house, you have the flexibility to invest in a residential or a non residential property. So, whether it is a new shop, office space, or a piece of land, Section 54F has got your back. Tax benefits under Section 54F. So basically, to enjoy the benefits under Section 54F, you must invest the entire sales proceeds into a new property within the specified time period. If you can't find the right property immediately, the option of depositing the capital gains in a capital gain account scheme is available here too. Remember, the conditions regarding the time frame, eligibility, and the location of the property remain quite similar to Section 54. So keep these factors in mind to make the most of the tax saving opportunities. So what are the conditions to fulfill for availing these exemptions? So let's talk about the checklist you need to tick off to ensure you can avail exemptions under these two sections. First and foremost, the property sold must be a long term capital asset. That means you have held it for more than 2 years. Short term gains, unfortunately, don't qualify for these exemptions. Next up, the new property you are investing So the new property you are investing in must be held for a minimum period known as the lock-in period. For Section 54, it is 3 years, and for Section 54F, it is 2 years. If you decide to sell or transfer the new property before the period is over, the exempted gain becomes taxable. So there you have it, the lowdown on Section 54 and 54F, your ultimate tax saving companion in the property transactions. So let's empower our friends and family with the knowledge to make informed decisions and make more money in their pocket. Until next time, happy tax saving adventures. See you tomorrow. Bye bye.